Let's say you got a big stack of cash laying around from an IPO, an inheritance, a business sale, a home sale, whatever it may be. You got all this money laying around and you're wondering, does it make sense to invest that money all at once or invest via dollar cost averaging? If this is you or might be you in the future, you don't want to miss today's video. How's it going, guys? My name is John Boyd. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. That's modern spelled with no vowels, wealth. If you like today's content, be sure to smash that like and subscribe button so you can get more content just like this. So, lump sum investing versus dollar cost averaging. Which one is better? Before we dive into that answer, if you haven't seen our video on dollar cost averaging already or are unfamiliar with the concept of dollar cost averaging, be sure to check out our video on it in the description of this video. So, what is the answer? So there's a technical answer and then there's the practical answer. So let me break it down for you guys. So the technical answer is that lump sum investing is the most optimal and most mathematically correct choice to make when investing over a long period of time. There are plenty of studies that support this. One of my personal favorite studies shows that if you miss the market's 10 best days during a bull market, your returns in your stock portfolio could potentially be cut in half, right? Again, you only had to miss 10 days to have that much damage in your portfolio. And the problem is that you don't know when those 10 days are going to be. Those 10 days could be next month. They could be next year. You don't know. That's why time in the market is better than timing the market. So if you have the money and you have a long-term investment horizon, you might as well be in the market now, right? So the reality is, with a lump sum of money and a long-term time horizon, it's pretty straightforward from a mathematical standpoint. It is more optimal to invest via a lump sum investment rather than spreading out that investment over a extended period of time through dollar cost averaging. But the problem is that isn't always practical for everyone. Let's say you sold a business and you now have 15 times the liquid capital laying around than you are used to. Investing that money all at once is probably going to be a psychologically tough pill to swallow. Because this is a tough pill to swallow, I often see people just not take action. They're scared. Right? They just sit in cash or they wait for that perfect time to invest. They'll say something along the lines of, oh, well, a recession is coming. I don't want to invest now, or I'll invest later once market pulls back. Then I'll invest that money. And again, from my experience working with investors all the time, these people tend to not take action. They tend to overthink those periods too, and they'll just sit in cash with all their money. So when you have a lump sum investment, that fear of the unknown for a lot of people, not everyone, but for a lot of people, can lead to paralysis by analysis, and they just don't take any action. So a nice happy medium to get these people to dip their toes in the water is dollar cost averaging, right? It's kind of like hopping in the pool with floaties on, right? You don't know how to swim. You're nervous about swimming. Well, hopping in the pool with some floaties, you might feel a little bit more comfortable. Then as you start to learn and you get comfortable, you take the floaties off and you're all in. And when you combine dollar cost averaging in these scenarios with limit orders and even cash secured equity puts, it can actually be a highly effective strategy. I'll give you an example. So I was working with a client one time. They had several $100,000 in a bank account. However, they just sold their business, and after taxes, were going to receive upwards of $10 million in liquid capital. A lot of cash to have on the sideline. Now, the reality is that this individual didn't need most of that money. They wanted to invest it. The problem was the idea of investing it all at once was highly nerve-wracking to this individual. It was a scary thought. A 1% drop on a $100,000 investment is very different than a 1% drop on, let's say, $10 million, right? Imagine logging into your phone and seeing all that red from a bad day in the market. So for this individual, psychologically, lump sum investing was just too much for them to swallow. So what we went ahead and did was constructed a portfolio and went ahead and slowly dollar cost averaged into various funds and different positions. We would have limit orders on various positions so that if there was a big pullback, we would buy extra during those pullbacks. And then we also had cash secured equity puts in place within the portfolio so that we got paid to wait. If you're not familiar with cash secured equity puts, there'll be a link in the description of this video with more information on them. But eventually, through the combination of these strategies, with dollar cost averaging being the star of the show here, we eventually had all that money invested, and it was a much smoother process for them. So if you are facing this dilemma, or might be facing it in the future, and you're trying to pick whether you should lump sum invest or dollar cost average, before you make that decision, have a clearly defined investment goal and financial plan. If there's no clearly defined goals or objectives, it's going to be impossible for you to have confidence in whatever decision that you make from an investment standpoint. Have clearly defined goals. Once you have those clearly defined goals, then be honest with yourself. If you feel like you're going to be a victim of paralysis by analysis and you're going to overthink it and be nervous, well, maybe dollar cost averaging makes sense. If you fundamentally understand the math and all the data that goes around lump sum investing for long-term investments, then go ahead and dive in. Again, there's an optimal solution here and a practical solution, but not doing anything isn't a solution at all. If you need help picking a strategy for your portfolio, feel free to reach out to us. www.modernwealth.com. That's modern spelt with no vowels, wealth. I'll see you next time, guys.